students, welcome to JK Shah classes. In this particular video, we are going to see RTP questions of paper 5 advanced accounting only related to accounting standards. So let us start one by one. Question number 12, which is related to AS4, contingencies and events occurring after balance sheet date. T Limited closes its books of accounts every year on 31st March. The financial statement for the year ended 31st March 2020 are to be approved by the approving authority on 30th June 2020. During the first quarter of 2021, the following events or transaction has taken place. The accountant of the company seeks your guidance for the following. So first of all, we have to see whether that particular event which is given in the question is adjusting event or non-adjusting event. If it is an adjusting event, then we have to do the adjustment with respect to the financial statement 2019-20 only, and if it is non-adjusting, then we have to give disclosure in directors reports, or if it is an insignificant transaction, then we can ignore giving disclosure also. First, T Limited has an inventory of 50 stitching machines costing 5,500 per machine as on 31st March 2020. Company is expecting a heavy decline in the demand in next year. It means they are saying that NRV will fall. The inventories are valued at cost or NRV, whichever is lower. During the month of April, due to fall in demand, the prices have gone down drastically as we discussed earlier. The company has sold 5 machines during April 2020 at a price of 4,000 per machine. So here the cost is 5,500, whereas the NRV of one stitching machine is 4,000. Now, apart from AS4, here AS2 will override this question. As per AS2, inventory should be valued at lower of cost or NRV, that is net realizable value. Obviously, that net realizable value is nothing but the expected sale value in the coming year reckoned in the month of April, which is given here, that is nothing but 4,000 per stitching machine. So definitely we should go for AS2. Inventories are valued at lower of cost or NRV. So here sir, cost is 5,500, NRV is 4,000. NRV being lower than cost, this inventory of 50 stitching machine as on 31st March 2020 will be valued at NRV of 4,000 per machine. Second, a fire has broken out in the company's godown on 15th April 2020. So first of all sir, fire took place on 15th April. Now on 31st March, being adjusting event, first of all we have to check whether any condition existing with respect to that event on 31st March or not, and later on are we getting any additional evidence with respect to that condition existing on 31st March for the purpose of estimation of amount. So here the fire took place on 15th April, definitely there was no condition with respect to fire as on 31st March that fire will take place on 15th April. So sir, there was no existing condition on 31st March, so definitely this is non-existing event. Now what they are saying, the company has estimated a loss of rupees 25 lakhs, of which 75% is recoverable from the insurance company. So being non-existing events, we can go for disclosure in director's report, but here you can consider that 75% is recoverable from the insurance company. So the loss is going to be only 25%. Alternatively, if the loss is to be considered as insignificant, we can ignore the disclosure also. So you can give alternative answer also. Point number 3. A suit against the company's advertisement was filed by a party on 10th of April. Okay, the case was filed by the party on 10th of April. 10 days after the year end, claiming damages of 20 lakhs. So basically this is contingent liability, but for contingent liability also, contingency should exist on 31st March. Here in this example, there was no contingency existing on 31st March. So definitely this will not be recorded in our books of accounts for the financial year 1920. So this will be recorded in the next financial year only. Now let us move towards the next question. Question number 13A. This is with respect to AS5, net profit or loss for the period, prior period items and changes in accounting policies. Basically in this standard we also studied changes in accounting estimate. That was nothing but the major area where many times questions are expected. The accountant of Mobile Limited has sought your opinion with relevant reasons whether the following transaction will be treated as change in accounting policy or not for the year ended 31st March 2021. Please advise him in the following situation in accordance with the provision of relevant AS. Obviously that is with respect to AS 5. First one, Provision for doubtful debts was created at 2% till 31st March 2020. From the financial year 2021, the rate of provision has been changed to 3%. So now we have to write whether this incidence or this particular transaction is related to change in accounting policy or not. So basically, sir, this is with respect to change in accounting estimates and not change in accounting policy, because obviously we change our estimate from 2% provision to 3% provision. So this is not change in accounting policy. Second, during the year ended 31st March 2021, the management has introduced a formal gratuity scheme in place of ad hoc ex gratia payments to employee on retirement. So basically earlier what management used to do, management used to pay a lump sum amount ex gratia payment to employee on retirement. Now they are moving towards gratuity scheme. Now if we are going for a gratuity scheme, dear students, in gratuity scheme we have to start creating provision also. So altogether we need a new accounting policy. So basically this cannot be considered as a change in accounting policy, because here as good as we are creating, or I can say making, a new accounting policy for a new type of transaction. So you can see the answer here which is given in the RTP. Adoption of an accounting policy for events or transactions that differ in substance from previously occurring events or transactions will not be considered as change in accounting policy. So definitely earlier there was no gratuity scheme. Now if we are going for a gratuity scheme, then we have to create accounting policy for making provision for the gratuity amount which we will be paying to our employees on retirement. Earlier there was no such transaction with respect to gratuity, no provisions were created. So now the transaction which we are going to enter into, that is altogether a new transaction. So definitely we will need new accounting policy. So this cannot be considered as change in accounting policy. Third, till the previous year the furniture was depreciated on a straight line basis over a period of 5 years. From the current year, the useful life of furniture has been changed to 3 years. So definitely, sir, this will be considered as change in accounting estimates and not a change in accounting policy, because here when we calculate depreciation, what is the formula for depreciation? So original cost minus estimated scrap value divided by estimated useful life. So here in calculation of depreciation there are two estimations which are involved. So when we derive at the amount of depreciation, that amount of depreciation is also nothing but the estimated amount only. So obviously if the amount is estimated, it can change any time. So this will also result into change in accounting estimate, rather change in accounting policy. Now fourth one, management decided to pay pension to those employees who have retired after completing 5 years of service in the organization. Such employees will get pension of 20,000 per month. Earlier there was no such scheme of pension. So again a new transaction. So for that we new accounting policy only. So it is not change in accounting policy, but basically we are creating, or I can say we need a new accounting policy only. So this cannot be considered as change in accounting policy, because transaction is altogether new only. Next, during the year ended 31st March 21, there was a change in the cost formula in measuring the cost of inventory. Basically earlier we followed FIFO method, let us say example. Now we are shifting to weighted average method. Definitely this will be considered as change in accounting policy only. Now let us move to the next question, which is related to construction contracts. B Limited undertook a construction contract for 50 crore. So basically this is nothing but the contract revenue. The cost of construction was initially estimated at rupees 35 crore. That is nothing but the total cost of contract. Initially they estimated at 35 crore. The contract is to be completed in 3 years time. While executing the contract, the company estimated that the cost of completion of the contract would be 53 crore. That is nothing but the total contract cost. Total contract cost. So contract revenue is 50 crore, whereas total contract cost is estimated at 53 crore. Now in the first year only, in the first financial year only, we came to know that was in this particular contract there will be loss of 3 crore. So now whenever we come to know that there will be loss, then that particular loss we have to recognize immediately in the year in which we came to know. So for the year ended 31st March 2021 only, we will recognize the entire loss of 3 crore with the help of provision. So here, can the company provide for the expected loss in the financial statement for the year ended 31st March 2021? The answer is yes, the loss of 3 crore company needs to provide. Next, AS9 revenue recognition. Question number 14A. An infrastructure company has constructed a mall and entered into agreement with tenants towards license fees, that is monthly rental. Okay, and variable license fees. Okay, so this company is going to charge from the tenants monthly rental as well as variable license fees, that is nothing but a percentage on turnover of the tenant, that is on an annual basis. So monthly rental, this company is going to charge from the tenant, as well as some variable rent that will be based on the annual turnover that will this company is going to charge at the end of the year. Chief financial officer of the company wants to account, or I can say recognize, license fees as income for 12 months during the current year and variable license fees as income during next year, since the invoice is raised in the subsequent year. Okay, so the company is charging monthly rental from the tenant, so they are saying we will recognize this monthly rental on a monthly basis only, or I can say in the year in which it is accrued. But they are talking about this annual rental, or I can say the variable license fees. Variable license fees, that is nothing but the percentage on the total turnover of the tenant. Here they are saying this variable license fees we will recognize as our revenue in the subsequent year, because the total turnover we will come to know at the end of the year, and then we will calculate the variable license fees based on the total turnover, and then we will charge the variable license fees and we will raise the bill in the next year. But dear students, remember one thing. See, monthly rentals are accruing on a monthly basis, whereas annual rental, or I can say this variable license fees, as accrued based on the current year turnover only, or I can say it is accrued in the current year only. Even though the payment is made, or I can say bill is raised in the subsequent year, but that particular variable license fees is accrued in the current year only, so that should be recognized in the current year only. Comment whether the treatment desired by the CFO is correct or not. Definitely it is not correct. We can just read the answer here. Revenue recognition is mainly concerned with the timing of recognition of revenue in the statement of P&L. The amount of revenue arising on a transaction is usually determined by agreement between the parties involved in the transaction. However, when uncertainties exist regarding determination of the amount, we need to postpone the revenue recognition, as you all are aware. Further, as per the accrual concept, revenue should be recognized as and when it is accrued, that is recorded in the financial statement of the period to which they relate. In the present case, monthly rental towards license fees and variable license fees as a percentage on the turnover of the tenant is the income related to common financial year only. It is income related to common financial year only. Therefore, recognizing the fees as revenue cannot be deferred simply because the invoice is raised in subsequent year. Hence, it should be recognized in the financial year of accrual only. Hence, the contention of the chief financial officer is not correct. Next, indicate in each case whether revenue can be recognized and when it will be recognized. First is trade discount and volume rebate received. Definitely this is not coming in the purview, or I can say it is covered in the definition of revenue, as you all are aware that revenue means gross inflow of cash or the receivables. So sir, here trade discount and volume rebate received should be deducted directly from the amount of revenue. There, in the definition, the word is given gross revenue. What do you mean by gross revenue? That is nothing but before deducting cash discount. So here there's a trade discount and volume rebate we should directly deduct from the amount of revenue. Where goods are sold to distributors or others for resale. Now dear students, unless and until the ownership of the goods is transferred to the customer, or I can say if the goods are given on sale or return basis, then the customer should approve those goods, then only we can recognize the revenue, or I can say in case of sale or return, the customer should either approve the goods or the time limit given to the customer to return the goods should lapse. Then only we can recognize the revenue. So basically here the understanding is, in case of goods, the risk and rewards attached to the property, or I can say ownership of the goods should be transferred to the customer, then only we can recognize the revenue. Next, where seller concurrently agrees to repurchase the same goods at later date. Basically, this is nothing but the financial arrangement. This is nothing but financial arrangement. Let us say example, today I am in a need of 5 lakhs rupees. So what I will do, I will sell my car to someone for 5 lakh rupees, and then I will tell that I will repurchase the same car from you only after 6 months at 5.5 lakh. So today I am selling this car for 5 lakhs. After 6 months I will repurchase this car from the same person for 5.5 lakhs. So I am giving extra 0.5 lakhs for that repurchase transaction. So basically, students, this is in the nature of financial arrangement. I'm in need of funds, I need some financial help, so I am just giving my car as a security and taking a loan. So obviously this cannot be recognized as actual sale. Here you cannot recognize a revenue. This is nothing but the financial arrangement. Here the loan interest, or I can say interest with respect to this financial arrangement, that is 50,000, should be recognized on accrual basis. Next, insurance agency commission for rendering services. So obviously agency commission can be recognized only and only on effective commencement of the insurance. So here you can see all the answers are mentioned. So insurance agency commission should be recognized on the effective commencement or renewal date of the related policies. Next, ASS 17 related question, that is segment reporting. Question number 15, A and B. 15A. Company A is engaged in the manufacture and sale of products which constitute two distinct business segments. Okay. Products of the company are sold in the domestic market only. Okay. Management information system, that is MIS of the company, is organized to reflect operating information by two broad market segments, rural and urban. Besides the two business segments, how should company A identify geographical segments? So basically what they have identified, that is nothing but rural and urban, that is nothing but geographical segments only. Do geographical segments exist when within the same country? The answer is yes, it can exist in the same country also. Explain in line with the provision of AS 7. So here clear-cut information is given. Accordingly, to identify geographical segment, company A needs to evaluate whether the segments reflected in the management information system function in environments that are subject to significantly different risk and returns, irrespective of the fact whether they are within the same country. So definitely within the same country there can be two geographies, or I can say there can be two geographical segments. B. Company has an inter-segment transfer pricing policy of charging at cost less 10%. Let us say example, segment A is providing raw material to segment B at a cost less 10%. The market prices are generally 20% above cost. You are required to examine whether the policy adopted by the company is correct or not. Yes, the policy is correct, nothing wrong in that. But whatever policy they have made, they have to disclose in their financial statement that segment A is providing raw material at a cost less than 10%. So that policy needs to be disclosed, but there is nowhere mentioned that segment A cannot give raw material to segment B at less than cost price. So definitely this can be a correct policy, or I can say this is correct policy, but here the disclosure needs to be given. Next, related party disclosure. In respect of a key supplier who is dependent on the company for its existence and the company enjoys influence over the prices of this supplier. Basically they want to say here there is a one single supplier. Can the supplier and the company be considered as related parties? See here, this was covered in exceptions to related party. You can refer the study material provided by JKC. Here also they have mentioned, we will just read. The supplier and the company cannot be considered to be related parties only because the latter is able to influence the transaction price between the parties. See, ideally in AS 18 related party, for establishing the related party relationship, there has to be control, or I can say significant influence. But here the party, or I can say the supplier, is not having any control. What do you mean by control? Sir, control means having ownership directly or indirectly of more than one half of the voting power, that is more than 50%. control of the composition of the board of director in case of a company, or the composition of the corresponding governing body in case of any other enterprise, or substantial interest in voting power and power to direct financial and operating policies. So this is nothing but the definition of control. Now reading the definition, by reading the definition of the control, now you guys only tell me, is a supplier is getting any kind of control in the organization? The answer is no. Insignificant influence, what is changed? See, here they are saying in case of control, power to direct financial and operating policy of the enterprise. Now in case of significant influence, it is power to participate in the financial and operating policy. Now being a single supplier only, supplier is not getting either power to direct the financial or operating policy or power to participate in the financial or operating policy. So definitely that particular supplier is not to be considered as related party. Now here you can see the exception which is mentioned here. Standard which states that a single customer, supplier or a franchisor or a distributor or a general agent with whom an enterprise transacts a significant volume of business only by virtue of the resulting economic dependence would not be deemed to be related party. So this is given in the exception part. Next, define key management personnel. So see, in exam if it comes, you have to just remember PDC rights. What are the PDC rights? Planning, directing and controlling. The one who is having PDC rights will be considered as key management personnel. So based on that you can write the answer. AS19 leases, interesting standard. Classify the following into either operating or finance lease. First, if the present value of MLP is X, where the fair value of the asset is Y and the X is equal to Y. So can I say present value of MLP substantially covers the fair value of the asset? Sir, here what do you mean by substantial portion? That is nothing but 90% or the above. Here, sir, it is 100% because they are saying the present value of MLP, let us say example 100, which is equal to fair value of the asset, that is also 100. So can I say PV of MLP substantially covers the fair value of the asset? Then definitely it is to be considered as a finance lease. If you remember, there were 5 indicators to define whether that particular lease is finance lease or not. In that, one of the indicator is that PV of MLP substantially covers the fair value of the asset. In that case, that particular lease will be considered as finance lease. Now, second, economic life of the asset is 7 years, okay, and the lease term is 6.5 years. But the asset is not acquired at the end of the lease term. It's okay. So, sir, based on the lease term and the economic life, there is one more indicator that lease term covers majority of the economic life of the asset. What I said, lease term covers majority of the economic life of the asset. Here, what do you mean by majority? What the standard is saying about majority? So here majority means 75% or the above. So definitely here standard is silent. So we are taking this information from US GAAP. So here I am saying this lease term covers 75% or more of economic life of the asset, then definitely that will be considered as finance lease. You can see here that lease term is 6.5 years, whereas economic life is 7 years. So more than 90% of the economic life is covered in the lease agreement only, since this also will be considered as finance lease. So first is finance lease, second is also finance lease. Third, economic life of the asset is 6 years, whereas lease term is 2 years, okay, but the asset is of a special nature and has been procured only for the use of lessee. So definitely, sir, this will also be considered as finance lease because it is of a specific nature and can be used by the lessee only with some modification whether lessee wants to do or not. So this is also one of the indicator to identify that particular lease is finance lease. Now let us move to the next question. Viral Limited sold machinery having WDV of 40 lakhs. Okay, this is nothing but the book value. To Saral Limited for 50 lakhs. That is nothing but the selling price. Okay, so this is nothing but the selling price. And the same machine was leased back by Saral Limited to Viral Limited. Okay, so sir, this is nothing but sale and lease back. The lease back is in the nature of operating lease. So sir, sale and lease back resulting into operating lease. One was sale and lease back resulting into finance lease. Now this is nothing but sale and lease back resulting into operating lease. You are required to explain the treatment in the given cases. Okay. So fair value and the sale price is given in individual cases, and we know the book value is 40 lakhs. So let me write here, sir, book value, fair value and the selling price. Sir, first situation, then the second situation and the third situation. Let us discuss one by one. Book value is 40 lakhs in all the cases, 40 lakhs, 40 lakhs and 40 lakhs. So fair value is 45 and the selling price is 39, 45 lakhs and 39 lakhs. Here 40 and 49, 40 lakhs, 49 lakhs. Then 46 and 50, 46 lakh and 50 lakhs. Okay. Now, in case of sale and lease back resulting into operating lease, there are two steps. Very basic, very easy two steps. First of all, compare your book value with fair value. First of all, compare your book value with fair value. So let us say in first example, sir, book value is 40 lakhs, fair value is 45 lakhs. So can I say there is a profit of 5 lakhs, which is a genuine profit? Because sir, in my books of accounts the asset is appearing at 40 lakhs, and if I go in the market to sell this asset, I will definitely get 45 lakhs. So sir, there is a profit of 5 lakh, which is a genuine profit. We should immediately record. That is now. Now means record now in our P&L. So we should record this profit of 5 lakh in our P&L. Now let us compare the second part, that is nothing but the fair value and the selling price. I am repeating once again. The first part was comparing book value and fair value. Now the second part is nothing but comparing fair value and the selling price. So in the first part, whatever is the profit or loss, that will be considered as a genuine profit or loss, because in my book value the value is 40, and in the market if I go and sell, I will get 45 lakhs. So sir, here the profit of 5 lakhs that we should recognize immediately, that is now only we should be transferring that profit or loss to P&L with a profit or loss. Why? Because that is nothing but the genuine profit or loss. Now let us discuss the second comparison, that is fair value versus the selling price. Now fair value is 45 lakhs whereas selling price is 39 lakhs. Now dear students, if I compare this fair value and the selling price, there is a loss. Loss of how much? A loss of 6 lakhs. Now here there is a two possibility. Here there is a two possibility. First possibility, that let us say example, I am having that particular asset with me. The book value in my books accounts is 40 lakhs. If I go in the market to sell, I will get 45 lakhs, correct? Now I am asking to the buyer, that is nothing but interested party, who is ready to purchase this asset, and that particular party will lease back that asset to me on operating lease. Okay, so now I am discussing with the interested party, or I can say related party. I am saying, see, in the market if I go and sell, I will get 45 lakhs, but I don't want today more. I want just 39 lakhs. Please give me little less amount. I am ready to sell my asset at a price which is lower than the market, but please adjust this benefit with respect to my future lease rental. It means today you give me less, but adjust, or I can say compensate this benefit with my future lease rental, because definitely in future the same party is going to lease back that asset to me on operating lease. So definitely that opposite party, or I can say the party to whom I am selling that asset, that party will become lesser is going to charge lease rental. So I will request lesser that please give me less amount today, because I am not in a need of such a big amount, that is 45 lakhs. I just need 39 lakhs. As compared to market, you give me less 6 lakhs rupees, but please compensate this loss, or I can say please compensate this amount of 6 lakhs in future lease rental. It means future lease rental will increase or decrease? Sir, future lease rental will decrease. So sir, we are going to get benefit in the future. So this loss is going to be compensated by the future lease rental, or I can say reduction in the future lease rental. So we are going to get benefit because of this loss of 6 lakhs. We are going to get benefit in the future. Then definitely this loss of 6 lakhs needs to be amortized. So sir, in that case, please amortize this loss of 6 lakhs. But there can be a situation where the lessor wants to capitalize this situation. He wants to take the benefit of this situation. He is saying, boss, I will give you 39 lakhs only, whether you want to sell your asset or not. Now I'm in need of funds. I need money. I don't have any other option. What I will do? Okay, in the market it is available for 45 lakhs, but I am not able to get that asset on again lease back in the market. So I am selling this asset to the lessor who will lease that asset back to me on operating lease, but that person is giving me only 39 lakhs. So he is capitalizing this situation. He is capitalizing this situation. So definitely in that case, this loss will be the permanent loss. We are not going to get any future benefits with respect to reduction in lease rentals. So this loss of 6 lakhs should be recognized immediately. This loss of 6 lakhs needs to be recognized immediately. Now dear students, how to write this answer? Now listen carefully. Now if I am talking about first comparison, that is book value to fair value, where book value is 40 lakhs and the fair value, I can say the market value is 45 lakhs. The profit of 5 lakhs is nothing but the genuine profit. Okay. Now what if the selling price is here is 39 lakhs and there is no compensation with respect to reduction in future lease rental? Then in that case, this loss should also be recognized now only. We should recognize this loss of 6 lakhs now only. Then in that case, profit of 5 lakh now, loss of 6 lakh now. So net loss of 1 lakh we will recognize. Net loss of 1 lakh we will recognize. And if this loss is going to be compensated by future lease rentals, or I can say reduction in future lease rental, in that case we will recognize 5 lakh of profit right now and we will amortize this loss of 6 lakhs in the term of lease. So you can see the answer is mentioned here. Read carefully. When fair value of leased machinery is 45 lakhs and the sale price is 39 lakhs, then the loss of 1 lakh to be immediately recognized by Viral Limited in its books, provided loss is not compensated by future lease payment. So if it is not going to be compensated by future lease payment, then we are not supposed to amortize. In that case, recognize this loss right now only. We are supposed to recognize this profit also right now only. So profit of 5 lakh, loss of 6 lakh, let us go and recognize net loss of rupees 1 lakh right now. But if this loss is going to be compensated by the reduction in the future lease rental, then in that case, we will amortize this loss of 6 lakhs in the term of lease. Hope you got this. So this is how you are supposed to mention answer in the exam. Now let us see the second. Again, sir, here first comparison will be between book value and the fair value. Sir, here it is not applicable anything because book value and the fair value is same only. Now here fair value and the selling price. Fair value and the selling price. Sir, here there is a profit. Profit of how much? Sir, profit of 9 lakhs. Now dear students, listen carefully. If I go in the market and sell this asset, I will get only 40 lakhs. But I am asking from the lessor, please give me more, please give me 49 lakhs because I am in need of urgent money, or I can say I am in need of more urgent money. So instead of 40 lakhs, can you please give me 49 lakhs? So lessor is ready to give me 49 lakhs. 9 lakhs more he is giving me today. Don't you think so? He will recover this 9 lakhs from the future lease rental. So here there is no option. Definitely he will recover this 9 lakh from the lease rentals in future. He will charge some extra lease rental from me in future. So definitely future lease rental will increase. So I can say lease rental will increase. It means expenses are going to increase. So definitely against those increased expenses, we have to amortize this profit. So profit will be always amortized. So in comparison between fair value and the selling price, this profit of 9 lakh will be amortized. Okay. So you can see the answer. When fair value is 40 and the sale price is 49, the profit of 9 lakh is to be deferred and amortized over the lease period. Last, sir, first compare book value and the fair value. That will be always genuine profit or loss, because obviously in my books accounts it is appearing at 40 lakhs. If I go in the market, people are ready to purchase at 46. So this profit is nothing but 6 lakh, which we need to recognize now. Now next, sir, but how much lessor gave to me? Or I can say I sold it to the lessor from whom I am going to take this asset again on lease back. So, sir, I sold it for 50 lakhs. So, sir, here also there is a profit. Here also there is a profit of how much, sir? 4 lakh. Now, dear students, tell me. Definitely, the lessor is going to recover this extra amount because lessor has given me more than the fair value, more than the market value. So, definitely he will recover this 4 lakhs rupees from me in future lease rentals. So, obviously, this 4 lakh of profit will also be amortized. So you can see here in the answer, when the fair value is 46 and the sale price is 50, profit of 6 lakh to be immediately recognized in the books, balance profit of 4 lakh is to be amortized, or I can say deferred over lease period. So simply the logic is, first of all, you need to compare book value and the fair value. Book value and the fair value when you compare. Book value and fair value when you compare. So whatever is a profit or loss, that you need to recognize immediately because that is a genuine profit or loss. In the second situation, or I can say second step, you have to compare fair value with the selling price. There, if there is a profit, then that profit will be definitely compensated by future lease rental. The lessor will charge higher lease rental as compared to the normal lease rental which he should have charged. So definitely in that case you have to amortize that profit. But in case of loss, there are two options. If loss is going to be compensated by reduction in future lease rental, then amortize that loss, else please recognize that loss immediately. Okay, let us move to the next part, that is nothing but AS20, earnings per share. Question number 18A. Stock options have been granted by AB Limited to its employees and they vest equally over 5 years. Okay, 20% at the end of each year from the date of grant. The option will vest only if the employee is still employed with the company at the end of the year. If the employee leaves the company during the vesting period, the options that are vested can be excised while others would lapse. Okay. Currently, AB Limited includes only the vested options for calculating diluted EPS. No, this is wrong. See, here even though the options are not yet vested, we should consider those as potential equity shares only. Potential equity shares means those financial instruments which is having potential of getting converted into equity shares in near future. So if I'm talking about near future, then definitely vesting conditions are not yet fulfilled. So definitely in that case, those options are still to be considered as potential equity shares, and we have to consider all potential equity shares, or I can say we have to consider all stock options which are not yet vested into the category of potential equity shares while calculating diluted EPS. Should only completely vested options be included for computation of diluted EPS? The answer is no, as I said. Let us see the B part, which is very interesting. X Limited, as at March 31st, 2021, has income from continuing ordinary operations of 2,40,000, a loss from discontinuing operation of 3,60,000. That is nothing but AS24 discontinuing operation, where the separate disclosure needs to be given with respect to profit or loss from discontinuing operation. In P&L statement, you might be like you remember, or I can say you must have seen in P&L statement at the end they have given a separate disclosure for a discontinuing operation, that we need to give a separate disclosure for profit or loss from discontinuing operation. So from continuing operation it is 2,40,000 profit, and from discontinuing operation there is a loss of 3,60,000. So accordingly a net loss of 1,20,000, that is at the end of the P&L statement. Company has 1,000 equity shares and 200 potential equity shares outstanding as at March 31st, 2021. When I'm talking about potential equity shares, it means they should have a capacity to dilute the EPS. They should have a capacity to dilute the EPS. And when I'm talking about capacity to have dilute the EPS, in that case, to measure the effectiveness of dilution, we should consider only profit from continuing operations. That is nothing but here 2,40,000. That is nothing but only 2,40,000. So first of all, we need to check whether these potential equity shares are dilutive in nature or not. For that checking purpose, we should take, or I can say we should consider only profit from ordinary, or I can say continuing ordinary operations. So first of all, we will check whether these 200 potential equity shares are dilutive in nature or not. Again, I am repeating, for the purpose of checking dilution, or I can say whether these potential equity shares are dilutive in nature or not, we should consider only continuing ordinary operations profit. So let us say 2,40,000. 2,40,000 is nothing but the profit from continuing operation. Now, the equity shares, that is nothing but 1,000 equity shares. So it comes to, sir, 240 per share. That is nothing but the basic EPS. Now, if I want to calculate the dilutive EPS, that is nothing but 2,40,000 divide by, now 200 potential equity shares are there, so divide by 1,200. So sir, 2,40,000 divided by 1,200, so sir, it comes to 200 per share. So here you can check, this is dilutive in nature. I can say these potential equity shares are diluting our continuing ordinary operations profit. So definitely we will consider these potential equity shares as dilutive in nature for the purpose of calculating diluted EPS. But now finally, while calculating diluted EPS, or I can say for the purpose of calculation of EPS, now we will go for the final net profit or loss, that is nothing but negative 1,20,000. So negative 1,20,000 divided by 1,000 shares and negative 1,20,000 divided by, so 1,200 shares. So you can see the solution. Here it is mentioned, for the purpose of checking whether it is dilutive in nature or not, we will consider the continuing operations profit. So based on that, we concluded that these potential equity shares are dilutive in nature, and then finally, thus the basic EPS would be negative 1,20,000 and diluted EPS would be negative 100. Thus basic EPS would be rupees 1,20,000, which is negative, and diluted EPS would be rupees 100, that is also negative. So here we saw that is nothing but the basic EPS, which will give you negative 120, and here it is nothing but diluted EPS, that will give you negative 100. Now let us move to the next question, that is nothing but AS 22. AS 22 talks about accounting for taxes on income. The following transactions are reported by PQR Limited during the year 2021. Tax rate is given 30% and few transactions are given. First of all, let's see, or I can say let's check what we are supposed to do here. You are required to show impact of the above items in terms of deferred tax asset or liability for the year ended 31st March 2020. Tax rate is 30%. Items disallowed in 1920. Okay. And allowed for tax purposes in 2021. Item disallowed in 1920 and allowed for tax purposes in 2021. It means as per Income Tax Act, or I can say in taxation, in the previous year items were disallowed. It means in the previous year taxable income was more. It means in previous year we paid more tax, result of which in the current year we will have to pay less tax. So in the previous year we must have created deferred tax asset, and now we are supposed to reverse the deferred tax asset. So in the previous year we created deferred tax asset. In the current year, that is nothing but for the year ended 31st March 2021, that is in 2021, we have to reverse this deferred tax asset which we created in the previous year. So you can see in the solution, this was related to timing difference, because definitely earlier it was disallowed in taxation, now it is allowed, so it was due to timing difference, and in the current year it is reversal of DTA because it was created earlier. That is nothing but the timing difference into tax rate, that is nothing but 6 lakhs rupees of deferred tax asset which will be reversed in the current year. Next, interest to financial institutions accounted in the books on accrual basis. Okay, but actual payment was made before the due date of filing return and allowed for tax purpose also. Okay, so in books of accounts, interest to financial institutions accounted on accrual basis, but in taxation we give deduction, or I can say it is allowable expenditure unless and until it is paid. So if it is paid, we give deduction of the same interest. So now they are saying the actual payment was made before the due date of filing return. It means in taxation also it was allowable expenditure because the payment was made. In books of accounts it was based on accrual, so there also we showed as an expense, and here also we have considered as an expense only, or I can say it was allowable expenditure in taxation. So sir, here there is no difference only, there is no timing difference, so nothing to be done, we just need to ignore. No timing difference, effect not applicable. 4. Donations to private trust made in 2021. So obviously this will go in your penal debit. All expenses will go in your penal debit, not allowed under income tax law. So obviously this will be permanently disallowed. This is permanently disallowed. So sir, this is nothing but permanent difference. Again here deferred tax, asset, liability, nothing will come into the picture. Now next, AS24, discontinuing operation. What are the disclosures and presentation requirements of AS24? Very easy question. Description of the discontinuing operation, whether it is a business segment or a geographical segment, date and the nature of initial disclosure event when we started disclosing this as a discontinuing operation, the date or a period in which discontinuance is expected to be completed. Like say example, it will take 1 year, 2 year, 3 year, I can say 6 months, whatever may be the expected time of completion. Then the carrying amounts of the balance sheet items of discontinuing operation, assets and liabilities, what is the carrying amount. Same in case of P&L also, we have to show the revenue and expenses separately of discontinuing operation. We also have to show pre-tax profit or loss. As I earlier also said, in P&L statement at the end, if you see, there is a separate heading for profit or loss before tax from discontinuing operation, tax on the above item, and then profit or loss after tax from discontinuing operation. Then the amount of net cash flows attributable to operating, investing and financial activities. Even though in cash flow statement based on AS3, there is a separate requirement of disclosing the cash flows from operating, investing and financing activity from discontinuing operation. Okay. Next, give 4 examples of activities that do not necessarily satisfy the criteria of AS24 or paragraph 3, but that might do so in combination with other circumstances. So what they are saying, what are the exceptions to discontinuing operation? So even though that particular transaction happened, or I can say that particular situation arise, still that will not be considered as discontinuing operation. There were 4 situations if you remember. First is nothing but the gradual or evolutionary phasing out of a product line or a class of services. Discontinuing even if relatively abruptly several products within an ongoing line of business. Shifting of some production or marketing activities, that cannot be considered as discontinuing operation. And last, closing of facility to achieve productivity improvements or other cost savings. So this is purely a theory answer. You can just mention 4 steps and you can just write. AS26, interesting question. Listen carefully. PQR Limited has acquired a brand from another company for 100 lakhs. Okay. PQR Limited contends that since the said brand is very popular and famous brand, no amortization needs to be provided. Not correct. As per AS26 intangible asset, the life of the intangible asset cannot be more than 10 years, or I can say there is a rebuttable presumption that the life of the intangible asset cannot be more than 10 years unless and until you have to prove that whether the life of the intangible asset is more than 10 years or not. Else, you have to amortize that intangible asset in maximum period of 10 years. Next, B. X Limited is engaged in the business of newspaper and radio broadcasting. It operates through different brand names. During the year ended 31st March 21, it incurred substantial amount on business communication and branding expenses. Okay, business communication and branding expenses they have incurred by participation in various corporate social responsibility initiatives. The company expects to benefit by this expenditure by attracting a new customer over a period of time, and accordingly it has capitalized the same under brand development expenses and intend to amortize the same over the period in which it expects the benefits to flow. First of all, how they can capitalize this expenditure? What intangible asset created? Because first of all, we have to see the recognition criteria of the intangible asset also. So first of all, we cannot even determine the cost of the intangible asset here, and which we need to amortize over the period of maximum 10 years. So here, which intangible asset has created? They have just done the branding expenses, or they have just participated in various corporate social responsibility initiatives. So that will not lead to creation of any intangible asset. So definitely this has to be charged to P&L, or I can say this has to be transferred to P&L straight away. As the accountant of the company, do you concur with these views? You are required to explain in line with the provision of AS. Okay. AS 29. Provisions, contingent liabilities and contingent assets. So they are asking, it seeks your advice in the following cases. Charles Limited has filed a court case in 1450 against its competitors. It became evident to its lawyers during the year ended 31st March 2020 that Charles Limited may lose the case and would have to pay rupees 3 lakh being the cost of litigation. No entries or provisions have been made in the books. So first of all, lawyer has already given the hint that we may lose this case, or I can say there are chances of losing this case. So definitely in this case there is a present obligation on the organization's head. Definitely they have to create the provision. In this case, provision needs to be created because now there is a present obligation based on the past event, and it is certain that there will be outflow of economic resources embodying the benefits to settle this obligation. Second, new regulation has been passed in 1920. Okay, so first of all, we are at the year end 31st March 2020. That is nothing but 2019-20. Now, a new regulation has been passed in 1920 by the healthcare minister, to upgrade facilities. Deadline set by the government is 31st March 2021. The company estimates an expenditure of 10 lakhs for the said upgrade. See, for the financial year 1920, there is no present obligation because the present obligation will come on 31st March 2021 because the deadline is given is 31st March 2021. So, by the time 31st March 21 comes, if we are unable to upgrade the facilities which are given here, then in that case we need to create a provision, because in that case on 31st March 2021 we will have a present obligation with respect to settle this item. Third one and the last one, company gives 1 year warranty for its healthcare equipment under the contract of sale that it will make good any manufacturing defect by repair or replacement. As per past experience, it is probable that there will be 1% such cases, and estimated cost of repair replacement is estimated at 10% of such sale value. 10% of the sale value. How to calculate? So they have mentioned that based on the sale value, 10% of such sale value will be considered as cost of repair replacement. But in how many cases repairs and replacement will come based on past experiences, sir? That is nothing but 1%. So definitely, sir, the probability is high that definitely the repairs and replacement will come. We need to incur the expenditure in the future. For that we will create the provision. During the year, the company has made a sale of rupees 5 crore. So now listen carefully here. Probability of warranty cases for the entity where repair replacement may be required as per past experience, that is nothing but the 1% of 5 crore, that is nothing but 5 lakh. An estimated cost of repair or replacement is 5 lakh into 10%, because total sale value is nothing but 5 crore. In that, in 1% cases, there will be a requirement of repairs and replacement. So, sir, that is nothing but in 5 lakh cases, or I can say in a cases where the turnover is 5 lakh rupees, estimated cost of repair or replacement will be 10% of the sale value. So, sir, 10% of the sale value of those items where the repairs and replacement is expected, that is nothing but 5 lakh. So, of 5 lakh, 10%, that is nothing but rupees 50,000 provision we have to create for this repairs and replacement cost, or I can say that is nothing but provision for warranty expenses. So, with this, all the question answers of accounting standards of RTP of paper 5, that is advanced accounting, is over. Thank you.